Good afternoon, everyone. My name is Leslie Gaddis, and I'm one of the advisors here at LifeTime Asset Management, and I want to welcome you to this episode of our Lifetime Learning Series webinars. Today's topic is one that is critically important for all of us, managing and protecting your credit, featuring our guest speaker, Chris Holt. Before I introduce Chris, I want to let you know that we welcome your questions. So if you have questions now or during the presentation, please email them to info@lifetimeasset.com. Again, that is info@lifetimeasset.com. We will try to address your questions at the end of the presentation, but if we run short on time, we will try to get an answer to you directly. Also, we are recording this session, so you can rewatch or share with friends and family later. So let's get started. We're extremely fortunate to have with us today Chris Holt. Chris is a senior mortgage consultant with CIMG Residential Mortgage, an independent mortgage bank based in Chapel Hill. Before joining CIMG, Chris was a senior mortgage consultant with FM Lending Services for over 13 years, where he sold and serviced residential mortgage loans, including conventional, FHA, USDA, VA, and NC housing bond loans. Chris is a graduate of the University of North Carolina at Greensboro, and as a resident of Durham, yay, me too, he can be found in his free time volunteering with the Duke Outdoor Adventures program, helping children and adults with disabilities to reach new heights in their indoor rock climbing program. That's really cool. Chris, welcome, and thank you for joining us today and sharing your thoughts and expertise.
Thanks so much. Glad to be here.
So to get us started, for people who don't have good credit scores, whether due to mistakes they may have made or just not having a credit or a borrowing history, long borrowing history, what's your advice?
It's a good question. I think the best advice I can give is that whether you're starting from scratch and building new credit or you're repairing old credit that has had some dings in it, it's a slow process. It takes some time. Anything that seems to be a quick fix is I would look at with wary eyes. There are numerous credit repair agencies, some of which will work in the correct way with people to help build or repair credit, some of which are trying to show quick results, and there can be some problems with that. So we'll talk a bit about that a little bit more during the presentation, but the takeaway is that it takes time.
Great. Well, we look forward to hearing what more you've got to say on the topic.
Thanks so much.
I'll hand it over to you.
Great. All right. So I'm very grateful to be here with y'all today, and to preface this, I don't work for a credit agency. I don't work for a credit repair company. I work for a mortgage lender. So this presentation is going to be through the eyes of a creditor, of someone who looks at credit reports on a daily basis and helps evaluate credit for a bank. So what we, and as you mentioned, I'm with CIMG Residential Mortgage. We are a mortgage bank in Chapel Hill, and all we do is mortgage loans, but a lot of the same logic is going to apply if we were to be an auto lender or a home insurance company. They're all companies that are evaluating your credit. So what is credit? It's the act of borrowing money with a promise to repay. Your credit report is your financial report card. So, just like a college would evaluate your transcripts or report card from school to determine whether or not they want to admit you, a lender will evaluate your credit report to determine whether or not you're a good credit risk. So learning how to play the credit game, so to speak, is a great tool for setting yourself up for financial success. Why is credit important? Lenders are using it to evaluate your ability to repay. Insurance companies use it to evaluate risk. Employers and landlords evaluate your credit during background checks. And also, while there are loan options and options available for people with lower credit scores, the higher your credit score, the better the terms of your loan. So in this case, as an example, how would good credit save you money? Comparing someone with an excellent credit score versus someone with a moderate credit score that's paying a higher rate. And these rates are higher than what you would see in today's mortgage market. But as an example, someone with person B, someone with an excellent credit score might have a 4% rate. Someone with a lower credit score might have a 5% rate. On a $300,000 home loan, that would translate to about $64,000 in savings over the life of the loan. So a little bit of work going into building a good credit score has the potential to save you tens of thousands of dollars, not just on your mortgage, but as you add up the interest paid on all of your accounts that you borrow money on over time, your credit cards, your auto loans, even the rates for your home insurance premium. As you add up the additional money you would spend on all of those accounts over time, it becomes exponentially more costly if you have a lower credit score. So, just like LifeTime will work with trying to maximize the return on your investment, you also want to minimize your expenses because those two go hand in hand. So this is getting into a little bit more meat and potatoes, what goes into your credit score. And I have plenty of people contact me with misinformation about what actually impacts their score. So I think it's worth spending a couple of minutes talking about this. You'll see 30% is on the total amount that's owed. And this is what's important is with credit cards, this is the amount owed per card in relation to the available credit, which is called the debt to credit ratio. So you may find that if you are maxed out on one of your credit cards, even if you have a good payment history, your credit score may be a little bit less than ideal. It may be that you pay all of your accounts on time, but at the time that one of your credit cards reports to the credit bureau, you had it maxed out, even though you paid the bill in full next month. So your credit report is really a snapshot in time. It's information that is last reported by all of your creditors to the bureau, and it's not in real time. So if you pay your credit card bill today, it may not reflect that payment on the credit report for another 30 to even 60 days because some creditors don't report every month. What is typical with most creditors for installment loans and credit cards will be that they report once a month, typically on the same date that they send the bill out to you. So that's not always the case, but I would say 90% of the time, that's when you can expect payments to be reported to the credit bureau is on the next billing cycle date. 10% of your score is new credit. So what's going on with accounts that have recently been opened? It can take, depending on the credit bureau, 3 to 6 months of payment history on a new account for it to start helping your score. However, you may see a drop in your credit score every time you open a new account. Those drops are temporary, and as soon as you develop a payment history, you'll see your score come back up. But it's important to know in the short term, new credit accounts can drop your score. So if you're looking to apply for a major debt like a mortgage loan, and you want to make sure you have the best credit score possible before you apply for that, I would avoid opening any new accounts in the 3 to 6 months prior to applying for that loan because those new accounts may ding your score a little bit. 15% of your credit report is the length of your credit history. So this is how long you had open accounts. And this is impacted by the accounts that are currently open. So again, prior to applying for any major credit, I would avoid closing accounts that you've had open for a long time. Anecdotally, the best credit scores I see are with reports where borrowers have had credit cards open for 20 years or more. Now, obviously, if you have an old credit card that has a high annual fee that is no longer serving you, it may be best to go ahead and close that account. But I would suggest maybe getting the input of a credit professional prior to closing that account to make sure it's not one that you need to help bolster your score. But one thing I would see a lot, especially as lower interest rate credit cards started rolling out maybe 10, 15 years ago, we saw a lot of people with older cards opening these new cards at a 0% introductory rate or a 1.9% introductory rate or something like that, transferring their balances to the new account and closing the old card. What that effectively did is it shortened the average length of their credit history, and it gave a brand new account on their credit report that they didn't have a payment history with yet. So I saw some people whose credit scores maybe dropped 30, 40 points almost overnight as they did this balance transfer offer. So something to be cognizant of, it's maybe not a bad idea to take advantage of a balance transfer offer to get a lower interest rate. If you're paying 20% on a balance and you can transfer it to a 0% rate for a year and get it paid off faster, it might be a great idea. But what I would counsel is not closing the old card when you do that. 10% of your score is your credit mix. So this is the mix of the types of accounts you have. The healthiest credit reports have multiple types of accounts. So that will include credit cards, that will include mortgage loans potentially, or other installment loans like vehicle loans. Sometimes it can ding your credit score to pay off your auto loan, which might seem counterintuitive. But if you have one auto loan and then a few credit cards, and you close the only installment loan you have and just have revolving credit after that, you may see a small drop in your credit score as a result, because your credit mix is no longer varied between different types of accounts. And then the 35%, the big chunk, everybody already knows this, payment history is important. What is also important is how recent the activity is. So if you have a late payment, it can have a very severe impact in the short term, like in the next 30 days. As soon as it reports to the credit bureau, your score is going to take a hit. And these are for late payments that are 30 days or more late. So if you have a due date on your credit card of the 5th and you make a payment on the 6th, depending on their grace period, it's probably not going to show up on your credit report. But with any account that goes 30 days late, it will show up on your credit report. And the more recent it is, the more significant the hit to your credit score. If you have some delinquent accounts, the best thing to do is get everything current and then just let it age out. And as time passes, your score will increase organically. There's nothing really that can be done to improve your score from the impact of a late payment other than letting it get old. However, there are some things this chart tells us that are things you can do to improve your credit score in the short term. And some of these things are things not to do, which we just discussed. Don't open any new credit right before you apply for major credit like a mortgage loan or an expensive vehicle loan. Don't open brand new accounts, which also shortens the length of your credit history, and don't close old accounts before you're about to go apply for a new major credit. But also, one thing that you can do to improve your credit in the short term in some cases is in this 30% amount owed section, reducing your debt to credit ratio on each account can be helpful. The ideal credit score will have a debt to credit ratio of 33% or less on each account. So if you have account, let's say you have a couple of accounts that you don't owe any money on, a couple of credit cards with a zero balance, but you have one that's close to maxed out. If you pay down the balance on that one card to 33%, you're going to see your credit score come up within the next month. It does help to, and there was an old way of thinking that if you needed to carry balances on revolving credit for long periods of time in order to build a credit score. That is no longer the case. You simply need to be making payments. So there does need to be account activity for it to help your score. So if you have a credit accounts that you haven't used for a year, at some point they're going to stop reporting to the credit bureau. At some point, there's not enough new credit information for the credit bureau to even score you. So you do want some activity. You do want to keep the balances low. If you're a person that has some open credit, but you don't need it and you don't utilize it, my suggestion is putting one of your recurring monthly bills on your credit card and just paying your credit card company instead of that bill. So Netflix is an example, right? Charge your Netflix to your credit card and pay your credit card instead of Netflix. If you don't have any recurring services like that, charge 1 tank of gas a month. Just keep activity going on your credit card so that they keep reporting to the credit bureau. What's in your credit report, and the first step to credit health is really knowing what's on your report, and we'll talk about that in a second. But what's in your credit report includes items like your biographical information, your name, birth date, social security number, address information, employment information. Employment information is based on based on employers reporting that information to the credit bureau, or a lender of some kind pulling a loan application or pulling a credit report in conjunction with a loan application that listed your employment. This is an area where there is often some discrepancies, and where you often, if you look at your own report, may find that there's employers listed that you didn't work for. There may be addresses listed that you didn't live at. It doesn't necessarily mean there's any sort of fraud happening, but it's not uncommon for maybe an auto lender at some point to put in a wrong employer by accident. Once they do that, it's on your credit report until you address it or it ages out. Account information will list the dates the account were opened, how much you owe, how much the credit limits are, how much the account terms, being the minimum payments and the length of the loan if it's an installment loan like a vehicle loan, and then your payment history, whether you've been paying on time. The section for public information includes liens and judgments, and there will actually be a separate section for collections. So these are more serious big ticket items that negatively impact your score, which we'll talk about a little further in a second. And then inquiries, who's been looking at your credit file? One thing that's super important is when you pull your own credit report through one of the services I'm going to talk with you about, or through a paid service like MyFICO as an example, you are not penalized with a credit inquiry for pulling your own credit report, okay? You are only penalized with a credit inquiry when a lender pulls your credit report at your request. And there's two sections to this inquiries section on your credit report. One are hard inquiries. These are inquiries where you actively asked for credit from someone and they had your permission to pull a credit report. Those do ding your credit score. And they will typically stay on your credit report for 120 days. After that, they will fall off your credit report as a hard inquiry, and the effect of that inquiry will come off of your credit score. There will also be other inquiries like for pre-approvals where the credit bureau has sold your information to a creditor stating that you're someone who may be eligible for an auto loan. So they sell your information to those auto loan companies, and there may be inquiries as a result of that. If you don't generate the inquiry, it does not count against your credit score, but it does tell you who's actually looked at your credit as a result of that. So talking about obtaining your credit report, there's actually an act of Congress that entitles you to a free copy of your credit report once a year from each of the three major credit bureaus, Equifax, Experian, and TransUnion. I highly recommend getting your free copy. You have a right to it. And it's a great way to monitor what's on your credit. Pulling it directly from the bureaus is also a great way to dispute any incorrect information. The easiest way to do it is to visit annualcreditreport.com. And you want to make sure you're using that actual URL and not some variation. There's plenty of companies out there that are trying to sell you stuff that have similar versions of that, right? Like just creditreport.com. That's not the free version. You want to go to annualcreditreport.com. There's also an 800 number you can call. You can request it by mail, but I recommend going to annualcreditreport.com and utilizing that service. They will allow you to pull free copies of your credit reports once per year from each of the bureaus. So a great practice is just setting a calendar reminder, a recurring annual reminder to pull your report once every 4 months with a different bureau. You always have access to one of the bureaus every 4 months, so you'll be able to see on a fairly frequent basis if anything is popping up. Now, if you're paying for a service that does credit monitoring, you probably don't need to do this, but this is a great free option if you don't want to pay for a credit monitoring service. One thing that's important to know, you don't just have one credit score, you have a whole bunch of credit scores. The reason for that is each of the three credit bureaus has different algorithms that are applied, so different versions of the same credit scoring software based on who's pulling the credit. So if you pull when you get your free copy of the report from the bureau, it's just the report, it doesn't have the score, but you can pay a little extra for the score. Last time I looked, it was $8 or $10, something like that. That score is going to be slightly different from what I would pull as a mortgage lender. An auto lender might pull a slightly different score. Your home insurance company might pull a slightly different score. So there's different variations. There are also a number of companies that will estimate a score for you So Credit Karma is an example I see all the time. It's a great free service, and it's a great way to get an idea about where your score is, but they're not actually pulling one of these scores from the credit bureau. They're pulling the information and they're using their own algorithm to try to calculate your credit score. I anecdotally see these scores are often higher than what we pull as mortgage lenders, sometimes by as much as 20 to 30 points. I would recommend if you want to pay for a score that you can deem to be fairly accurate, I would go directly to the credit bureau like Experian or Equifax and pay for the score directly through them. Another word on inquiries, we talked about how when you inquire for credit with somebody, it is a hard inquiry and that does impact your score. You are not penalized for shopping. So if you have multiple inquiries within a 14-day window for the same type of product, it's one inquiry. Now, if you apply for an auto loan on Monday and a credit card on Wednesday, that's two inquiries. So it is important that it be for the same type of product. But if you are shopping for a mortgage loan and you want to get rates from 5 banks and you call them all within the same week, that's only one inquiry. You're not penalized for that. Some implications of negative information that could appear on your credit report. A late payment can hit you up to 110 points, depending upon what you're late on. A mortgage late is going to be the most significant impact in your score. If you have otherwise excellent credit and you have a mortgage or you have a late on a credit card, it may just ding your score 20 or 30 points, and that may go away pretty quickly, and it probably wouldn't impact anything else in the grand scheme of things. But if you have other things going on at the same time, so if you have a new collection account and then all of a sudden you have a late payment, and maybe there was a bankruptcy a year ago, like you're going to start seeing the impacts stack up, and you're going to see drastic credit score drops in the short term. So again, one late payment and you haven't had one in the last few years, probably not going to hurt you a whole lot, but a late payment on a mortgage almost always will. So definitely something to protect against at all costs. Having a foreclosure, obviously, or a bankruptcy, very significant impactors on the credit score. A brand new collection it will have a significant impact. A hard inquiry can be up to 15 points. Anecdotally, I see that it is also in relation to what's going on. So if you have some recent late payments or you've opened up a brand new accounts and then you have a new inquiry, it may hit you a full 15 points. If you don't have many credit inquiries, you don't have a lot of other negative activity going on in your report, and you have one inquiry for an auto loan, it might only hit your score 2 to 4 points. So that's what I see anecdotally, is that a hard inquiry will really depend on the impact of it will depend on what else is going on in your credit report. One thing with regards to collections that this brings up, there are a number of credit repair agencies that will take the tactic of just disputing all negative information on the credit report right off the bat. And what I want to warn you against with companies that do that, and I'll tell you why they do that. When you file a dispute with the credit bureau, the creditor has 30 days to respond. And if they don't respond, the credit bureau has to remove that negative information from your report. So companies that dispute everything are banking on the fact that a certain percentage of creditors won't respond in time, and your credit score will come up as a result. And then they can advertise to you, well, like, you've been paying for this service, and look, your credit score already came up 50 points just based on these disputes. That is accurate. It can work. However, if it is a legitimate collection and they're still within their legal time period for reporting, if it's removed because they don't respond to the dispute in time, they still have a right to place that collection back on your credit report. And guess what? The credit bureau is going to read that as brand new activity on a collection account and is going to hit your credit score with the maximum possible. If this was a collection account that was 2 or 3 years old already, it may still be having some impact, but nowhere near the impact as a brand new collection. So I've seen people go through this process of disputing items only to find out that something pops back onto their credit report, maybe while they're even in the middle of a mortgage loan process, and starts tanking their credit score. So something to avoid. Obviously, if there's negative information, it needs to be disputed if it's inaccurate, right? Like if there's a collection showing a balance and you've paid it, it should show a zero balance. But I wouldn't take the tactic of just disputing everything that's negative if it's accurate information. So that leads us into talking about accurate information on the credit report. You're the one who's responsible for making sure the information on your report is accurate. There's not like a phone bank at the credit bureau who's sitting there working on everybody's report to make sure it's accurate. Like they're just collecting the information that's given to them by creditors, and plenty of creditors make mistakes. So you're responsible for correcting mistakes or inaccuracies. If there's enough inaccurate data on your credit report in that identifying section, so we talked about, it's going to have your name, your birth date, your social security number, but also employment information and address history. If there's enough inaccurate information, I have seen credit reports with other people's credit information pulled into the report because there was enough inaccurate biographical data, okay? So especially if you have a common name or if you have family member, if you're like a junior or a third, or have family members or, just a common name that there's plenty of, John Smiths out there. If there's also matching information, like maybe there's multiple people with your name that work at the same employer or have lived in a similar address to yours before, it can start pulling in their credit information, good or bad. So that's a really good reason why it actually makes sense to take the time to go through all three major credit bureaus and check out the biographical data and dispute it if it's inaccurate. A little bit of legwork there can save you huge headaches later on. Potentially, you don't want to be in the process of buying a house and realize all of a sudden that somebody else's credit is on your credit report. That could be really problematic. You will want to get copies of your own credit reports, file a dispute on errors or any inaccuracies, but again, don't dispute information that is accurate. Managing your credit, how to build good credit. Okay, so we've talked about some of this already when we were looking at the graph, but keeping older accounts when possible, having a mix of installment and revolving accounts, store cards, like, when you go to JCPenney's and they're going to give you 10% off if you open a store card with them. Store cards, if you don't have any credit and you're looking to establish your first card, sometimes they're a little more accessible for opening up a first card. But in the long run, they don't help your credit score as much as traditional credit cards. I wouldn't say they're bad accounts, but if you're looking to actively build credit, I would try to get traditional credit cards first prior to looking at store cards. I would also be careful with unsecured debt consolidation loans, these companies that will roll all your credit card debt together in an installment loan and lower the total monthly payment. It may be something you need to do to get a handle on out of control debt, but be advised that those unsecured installment loans don't help your credit score as much as regular credit cards or regular installment loans. So be aware of that. Again, you don't need to carry a balance to build good credit scores. Credit scores are optimized with balances of 33% or less on the available credit on revolving credit. This debt to credit ratio doesn't matter on installment loans. So your car loan, you don't need to pay it off faster to develop a good credit score. You may want to pay it off faster to save interest on the installment loan because that will help you, but it's not going to help your credit score to do that. If you have unused cards, again, charge something small once a month or at least once every 6 months to make sure they continue to report to the credit bureau. If you have old collections, you may want to consider not disputing any information. You may not want to pay them at that point. If something is years and years old and you pay it and they report to the credit bureau that the account's been paid, it will actually lower your credit score in the short term. If they haven't reported to the credit bureau in years and you pay something and then all of a sudden they report, the credit bureau reads that as new activity on a collection account. even though it's positive activity, and this is counterintuitive, your score will temporarily lower. If you have collection accounts that are actively reporting though, even if it's an old bill from 3 years ago, but they're still reporting it to the credit bureau every month, those should be a top priority for getting paid, because the sooner you pay them, the sooner they will stop reporting, and the sooner your credit score will start to improve. When rebuilding credit, obviously, you want to work on a household budget. We want to avoid any late payments. We want to make sure we avoid any potential pitfalls that are going to cause a collection to show up. We want to make sure we have things like a prudent reserve of some cash assets to handle the emergencies that are inevitable, right? You want to make sure there's cash on hand to cover, like let's say your car blows up and needs to be repaired. Better to have cash on hand than that on hand for that than to be relying on maxing out your credit card to cover something. So just a word on that there. Try not to overextend yourself with applying for too many cards. It can be a really easy trap to fall into, especially, the availability of credit can be as much of a snowball as the problems that can happen with mismanagement of credit. So, you'll find that you open a few accounts and you have a good payment history. All of a sudden, you start getting credit card offers all over the place, and it can be very easy to take on more available credit than you ultimately should or would be comfortable with. And if you get declined for credit, try to find out why. See what the reasoning is. Whenever you're declined for credit, they should send you a letter stating what the reasoning was for that. Likewise, whenever you apply for credit, for a mortgage at least, they'll be sending you a breakdown of the credit scores that were used for the credit decision, as well as any things that might be impacting the credit scores. You want to be checking your credit report at least annually. You want to consider signing up for a credit monitoring service. They do cost money, but getting notified of any major changes in your credit card or your credit report status could be very crucial. The faster you address any potential issues like credit fraud, the better. I do recommend keeping your credit bureaus frozen, like your credit files with all 3 of the bureaus frozen, and actually writing down the PIN code they give you when you freeze it, because you will need it later. But our credit information, I don't know the actual stats on the percentage of people whose credit report information has been compromised, but it's a staggering number. You've probably received an email at some point from one of your creditors saying, oops, sorry, your information was compromised. Here's a free copy of your credit report as a result, or something along those lines. If you haven't, it's coming at some point. The best way to protect yourself is to keep your credit files frozen with all 3 bureaus and just temporarily unfreeze them when you need them. So I think that is about it for me for now. I think we may have a few questions to go through, and I'll turn it back over to Leslie, and hopefully we can answer some questions for you as well.
Yeah, thank you so much. This is great information, and we love these webinars because we learn a lot too. And I've scribbled down a lot of notes here. I actually one thing that I did not realize on the credit utilization, I was thinking that it was the aggregate amount of credit available, but you're actually saying that it's on a card by card basis. So you want to keep that usage at less than 33% on each card if possible.
That's correct. And sometimes, you incur fees for balance transfers, so they're not always a good deal. But if you strictly from the standpoint of trying to maximize your score, sometimes it's best to do balance transfers to spread the debt out between multiple cards so that you're not maxed out on any one card.
Okay, I'm glad you clarified that for me. And that actually, you gave a good example about the effect on credit history and people that take advantage of the credit transfer, balance transfers, and that made me think of another situation for folks going through a divorce, and this actually happened to my brother, that they had to close all the joint credit card accounts, and that really dinged his credit. So just for people who are going through that, being mindful, especially if they're having to buy out a mortgage, a house or something from a spouse, that they want to be aware that is a possibility. Obviously, if there's a lot of acrimony and you may need to close out those joint accounts to protect yourself. But anyway, it's just a concern. So what are your thoughts on Experian Boost, which I believe is a program that enables you to get credit for bills like a cell phone or utilities or even a streaming service that is not otherwise reported to the credit bureau? Have you found this to be valuable for folks?
So what I've seen so far, and I will preface this by saying I don't have a ton of experience with this yet. I have a couple of clients that have been trying this. They have not noticed huge results in the short term. I've also polled some other loan officers about Experian Boost, being a relatively new product, to see what they've experienced, and some report small improvements in score. I don't think that it can hurt in any way to utilize a service like that, to put that information on the report. But I would say it's a little too new to determine if it's a really useful thing to try. So, if you don't have a lot of open credit, it might be worth trying to see if it helps, but don't have a ton of data yet. Part of the, one of the things is the credit scoring software is proprietary for each of these bureaus. So we have, the industry has figured out a lot of things about what likely impacts score, but we don't actually truly know 100%. So a lot of this is trial and error, like what happens if we do this, right? There's plenty of track record for a lot of things, but we don't have enough track record yet on Experian Boost.
Okay, yeah, it seems like the credit bureaus keep their algorithms close at hand, so they don't let people know exactly how they calculate the score, which is frustrating. And then, so what about people who just never use credit cards, or they never have taken out loans because they've always paid cash for their purchases, and then they come like for a mortgage, because that's something that most people can't pay cash for a home. So is it possible for someone like that to get a mortgage?
So specifically from a mortgage, I can't really speak to how this would impact like a vehicle loan or home insurance or something like that. But from a mortgage standpoint, if you have multiple borrowers on the loan and one of them doesn't have a credit score due to a lack of open credit, that is often acceptable and often fine. If all borrowers on the loan are unscored due to lack of open credit, then lenders have two ways they can do mortgage loans. The first is, what is done 99% of the time is by utilizing what's called an automated underwriting system. So that means I get all your information, I get your credit report, I run everything through this automated system, and it's going to kick out an approval or a denial, right? So it's pretty straightforward. There is also the option of doing what's called a manual underwrite loan, which is where the lender, where an underwriter doesn't use an automated system to approve the credit. They're manually reviewing all details of the loan file themselves. With that, you can build an alternate credit history utilizing things like your payment history on your rent, your payment history on other open accounts that you have, like your cell phone bill, your auto insurance, things like that. Those loans are possible. I will tell you that these days, many lenders that used to offer them have temporarily stopped because loan volume is so high and these loans are so time intensive that they don't have the time to work on those types of loans. So it can be done. It is more difficult in the current environment if you don't have a credit score.
Okay. Yeah, and then people don't, that's one of the criticisms of the credit score is, people that are doing things right or being responsible are punished for it, I suppose. And I guess that's what
I absolutely think of it as a game. And,
yeah,
like if you want to win the game, you got to play and there's rules to it. And I don't, even being in the industry, I don't always like it. It doesn't always feel good. And it doesn't always make sense. But, here's the box, here's how they do things. We have to figure out how to get in that box if we want to get the best possible terms to set us up for financial success. So, it's a double-edged sword for sure.
Yeah, I was about to say the same thing. And speaking of, you mentioned paying off car loans early or other types of loans early can ding your credit. So, for somebody who's applying for a mortgage, would you tell them to hold off on if they were thinking about making a move like that until after the mortgage process is complete?
So with a mortgage specifically, I always recommend no major changes in the couple of months leading up to applying for a mortgage loan. It's very rare that you can make some major change that's going to improve your score other than paying down revolving debt. So if you have some cash and you want to pay down credit cards, that will probably help you. Anything else will probably shoot you in the foot. So, if it turns out that you need to pay off a car loan to qualify for the amount of mortgage you want, that may be a valid reason to pay off a car loan. But I would wait to do that until a lender evaluates your credit report, and you want the car loan to show on the credit report when they pull it so that you have the highest possible score. And you can tell them, if it's going to help me to qualify for this $400,000 loan, I would like to pay this car loan off. Let me know if that's needed. And they'll tell you, and you can do that during the process. I would avoid doing it preemptively without having a lender look at something.
Okay. And I mean, and really, it sounds like the mortgage application process can be a collaborative process. It's not just, so you can, speak to your mortgage broker and get some advice before you kind of take the leap and make the official application. That might be worthwhile.
Yeah, it's really good to have a preliminary phone conversation, really, or in person, depending on, the state of the world, but or even Zoom. I'm doing a lot of Zoom consultations with people, and they can run those questions by me, like, well, I've got this thing or that thing. What do you think I should do? And it's good to have those conversations in advance.
Great. Well, this has been a lot of very interesting and very useful information, very nuanced. A lot of aspects here. It's complicated. So thank you for shedding some light on it for us. And so we're almost out of time. But if you do have questions after the presentation, or if you are watching the recording, later on when we post it to our website, please don't hesitate to contact us by emailing us at info@lifetimeasset.com. We do have more great webinars coming your way. The current schedule is the first and third Thursday of each month. We will be taking a break for the summer, so after the May sessions, but that's our normal schedule. Our next webinar on April 1st will feature Paul Stingle from City National Rockdale, who will be talking to us about U.S. debt levels, which is top of mind and a very timely discussion that we hope you'll tune in for. So thanks for your time today, and especially Chris, thanks again for sharing your expertise. As a reminder, we will be sharing a recording, so keep an eye out on our website, and we'll see you next time.
Thanks so much for having me.
Yes, you're welcome. Thank you, and everyone be safe out there.